Jack, one of the biggest misconceptions that I think the long-term care industry and it also the annuity industry suffers from, and it is a misconception, is I'm going to set up this long-term care plan with Jack Lenenberg, the top long-term care expert in the country, but if I don't use it, money goes poof. Please explain and clarify and pound the table and yell into the microphone that that's not true, and you can set things up so that 100% of the money goes to somebody in your family if you don't use it.
Well, true. I mean, so there's different ways to fund the plan, right? You know, we have the old way of doing it. The traditional way was you just buy a standalone long-term care insurance policy, and you pay premiums monthly or annually for the rest of your life. And if you don't need it, well, yeah, you pay for insurance, and the money went away.
What is what percentage of the marketplace does that product represent right now in your guesstimate?
Wow, a lot lower than it used to be. It might be down. I mean, it might be down to 20% today, 25%, where it used to be 100, right?
Right.
So now the market has completely shifted. So the other way to plan, policies are called asset-based policies, where they combine the long-term care benefits with a cash value policy, an annuity contract, or a life insurance policy, such that the money that you pay for your plan, if you don't need care, comes back to your estate at your death. Generally with most of the plans, the money that you put in, all of it will come back.
Repeat that again. I'm going to interrupt you. I need you to repeat exactly what you said again, because I can't tell you how many people call me, and I can't imagine you get it. I mean, just repeat that again, that you're placing your money there. Yes, you're getting long-term care coverage, but if you don't use it, money comes back to you or your beneficiaries. Say
Absolutely.
that again.
So we're repositioning the premium, and we're growing the money for long-term care. We're not growing the money, for investment gain. We're repositioning money, growing it for long-term care if care is needed, but if not, the insurance company returns the premium at death, 100%. So, essentially, you win in three ways. I mean, if you live too long, you have long-term care benefits, tax-free. If you die, money comes back for the death benefit. And with a lot of the plans, even if you change your mind and you quit, you get the money back. They have, cash surrender value to where if you change your mind, you can get some, or a few companies still will give all of the money back, but that's been changing recently. But yeah, the plans are completely flexible. Benefits are guaranteed. Premiums are guaranteed. And if you don't need care, the money comes back to the estate. So with my high net worth clients who have assets of $3 million, or more or less, again, there's no risk to the plans because we're just taking money from our right pocket and putting it into our left pocket. It's still our money. But if we need care, the insurance company, puts in their money. And there's plans that provide lifetime unlimited long-term care coverage forever if you need it.
So when people go to ltcpartner.com and they contact you, they just need to be very, very specific on what they're going to trying to achieve and what their hopes and wishes are for the product. You're going to tell them whether it exists or not. And if it does, you're going to quote all carriers. If it doesn't, you're going to tell them, you can get close to what you're dreaming of right here. But once again, you're kind of looking at it as a commodity product. You're quoting all carriers?
Oh, everybody. Yes. All types of policies, traditional policies, the asset-based policies, whatever my clients want to consider, I can show them what the rates are based upon their age, based upon their health, for any policy.
Well, why would somebody choose that traditional policy, Jack? Why would someone choose that? Why would someone choose the traditional policy the one that keeps lowering, the people who are buying it, the percentage lowers every single year. Why are people choosing that?
Well, it's, some people are more comfortable with just, let's say someone has not a lot of liquidity, for example, right? But maybe they have a pension, $8,000 a year, and Social Security on top of that. So maybe their strength is just guaranteed income, right? And they might not have the liquidity to maybe use towards an asset-based policy. Well, for someone like that, a traditional policy, if it's $500 or $600 a month, and they know that they have $10,000 a month of income for life, they could reposition some of their income and get the coverage very easily. So and then some people don't mind just paying for insurance, right? We have homeowners insurance, auto insurance. We write a check. If our house doesn't burn down, we don't get anything back. So, there's nothing wrong with a traditional policy. The risk with the traditional, the one risk, the insurance company could change your premium. That's the risk. So a premium could change. So you're getting into a contract on a traditional policy with the insurance company where they could increase your premiums. And that's what a lot of my clients are concerned about with the traditional, is the fact that the rates aren't guaranteed.
Hey, Stan the Annuity Man here. Did you like that little taste of my podcast, Fun with Annuities? Hey, if you want to see the full version, click the link and watch the whole darn thing. Remember, Fun with Annuities. Live in the reality, not the dream.